Investors have seen fantastic gains in tech stocks in the major indexes recently, but is it sustainable? In this video, we'll explain how rampant out-of-the-money call buying has been a major driver of gains and volatility in the stock market throughout 2023, and why we may be in a risky position in the second half of this year, particularly with high-flying tech names that have been driving the market upwards like Apple, Nvidia, and Tesla. Calls are option contracts that allow the buyer to buy a stock at a specific price, known as the strike price, at a future date. The option is considered out of the money if the strike price is above the current price of the stock. Zero DTE, or 0 days to expiration options, are options contracts that are expiring on the day that they are traded, meaning that by 4 p.m. if they are not in the money, they will expire worthless. These contracts have become increasingly popular both with retail and institutional investors, resulting in the highest options volume ever seen in the markets. From this Reuters article, I found this one bit to be very interesting. For S&P 500 options, an index product favored by institutional investors, trading in 0 DTE contracts accounts for about 44% of the 10-day average daily options volume, up from about 19% a year ago. They also go on to say that some analysts worry that such a surge of one-directional trading could exacerbate intraday market moves, especially if it comes during a time when liquidity overall is lower than usual. Analysts at JP Morgan estimate that a large market move would cause these options positions to spark buying or selling to the tune of $30 billion, delivering a volatility shock similar to the Volmageddon crash of 2018. We have also seen daily S&P 500 index 0 DTE options eclipse $1 billion in daily volume, a figure we've never seen before. Let me explain why this trading activity has created a systemic risk in the stock market and for tech stocks. Here's the basic sequence of how large numbers of out-of-the-money call buying can drive up the value of stocks. When investors purchase a large amount of out-of-the-money call options, especially those with 0 days to expire, the market makers who sell these options contracts need to hedge their positions. This is because if the stock price does indeed rise above the strike price, they are obliged to provide the stock at the lower strike price, potentially leading to losses. To hedge their positions, market makers typically buy the underlying stock of the options contracts they've sold. This is known as delta hedging, where the market makers aim to become indifferent to the price movements of the underlying stock. The idea is that any loss they would incur from the option would be offset by the gain on the stock they've bought. If the scale of this out-of-the-money call buying is substantial, as it has been in recent months in the market, the corresponding buying of the underlying stock by market makers to hedge their positions can result in increased demand for the stock. This increased demand can put upward pressure on the stock's price, something that can be seen in most tech stocks in early 2023 as they jumped off the lows of last fall. This rise in stock price can, in turn, make some of the out-of-the-money calls in the money, meaning their strike price is now below the stock's price. This might trigger more buying by market makers to further hedge their positions and protect themselves from the potential for extreme losses should the stock continue to rise. Thus, a feedback loop can be created, pushing the stock price higher, which is often referred to as a gamma squeeze. This process has been a major driver of volatility in several high-profile tech stocks, particularly in 2023. In some cases, retail traders or hedge funds may coordinate to buy large amounts of out-of-the-money calls, driving up the price of the underlying stock significantly and creating bubbles throughout the market. Some, including myself, believe this mechanism has been a major factor contributing to the price increases of tech stocks like Apple, Nvidia, and Tesla, amongst many others. Additionally, trading volumes in 0 DTE options for index ETFs like SPY and QQQ are at all-time highs, further validating the theory that this activity is driving the market in speculative ways. 0 DTE options popularity amongst retail traders, coupled with the widespread availability of zero-commission trading platforms, has made it easier for large numbers of call options to be purchased, setting off the delta hedging process more frequently in many individual stocks over recent years. This has created substantial upward pressure in their stock prices, leading to significant price increases. It's important to mention that these increases can be temporary if they're driven by options activity rather than the underlying fundamentals of the company. When the price of a stock is driven up by mechanisms like the delta hedging process I've described, rather than by the underlying performance or potential of the company, there can be a substantial risk of a price correction. This can frequently be seen when a less profitable stock or company is gamma squeezed, like Bed Bath & Beyond was prior to going bankrupt. What is often not considered is how, when the largest companies that drive the broader market are driven up through this process, many other market participants see the gains being caught in tech and have gotten FOMO and reinvested into equities. This has created a shaky market environment heading into the second half of 2023 for a variety of reasons. In an ideal market scenario, The price of a company's stock is a reflection of its current performance and future potential, taking into account factors such as revenue, earnings, market position, growth prospects, and so on. When a stock's price is instead driven up by speculative options activity, it becomes disconnected from these fundamental factors. The inflated price may not be sustainable because it's not backed by the company's actual financial performance or growth potential. The delta hedging process and associated gamma squeeze can also lead to higher volatility in the stock's price. Large price swings can create an unstable trading environment, potentially leading to significant losses for investors who buy in at the inflated price and then can't sell before a price drop. If the coordinated call buying were to cease, the inflated demand supporting the stock's elevated price would disappear, leading to a sharp price correction. This is particularly likely if other market participants recognize that the stock is overvalued and begin to sell their shares. If a stock's price begins to fall, particularly after rapid increases, it can trigger negative market sentiment and even panic selling, which can further drive down the stock's price and keep it down for an extended period of time. The struggles of companies that rose throughout the dot-com boom is well documented and can be seen clearly in the charts of companies like Yahoo, Cisco, and Amazon. For stocks like Apple, Nvidia, Tesla, and other high-growth names, their high valuations have already been a subject of debate. In an adverse market environment, these stocks could face significant selling pressure. Should rates and inflation stay higher than previously thought, these companies will face an increased cost of capital and discounted future cash flows. They will also face a tougher fight for investors' dollars when compared to value stocks or bonds. While the speculative nature of call buying and delta hedging can drive up stock prices in the short term, it can create a risky trading environment where stock prices become vulnerable to sharp corrections. This underscores the importance of investing based on thorough research and a clear understanding of a company's fundamentals. During the dot-com bubble of the late 90s and early 2000s, many tech companies like Cisco and Amazon were highly valued based on optimistic growth expectations, much like today's tech giants. When the bubble burst, stocks that were overvalued based on unrealistic expectations fell drastically. However, companies with strong fundamentals and real growth potential, like Amazon, were eventually able to recover and reach new highs after many years. Now, companies like Nvidia, Apple, and Tesla do have established businesses and generate substantial revenues, unlike many of the companies caught in the dot-com bubble. However, their current high valuations are based on the expectation of substantial future growth, which could be threatened in a high interest rate environment, with markets that have been bid up through speculative trading activity being at an all-time high. I expect that we will see a major correction in these tech stocks in the second half of 2023. Do you agree? If you do or don't, let me know in the comments below, and subscribe to the channel as I'll be covering this topic further, as well as some strategies that can be employed to capitalize on this speculative market. Thanks, and have a great day.